Well, thank you very much, Mayhal, for having me on the Forge Advisory podcast today. I really appreciate being here, and I appreciate your team really taking the time to do some due diligence on behalf of your clients with Pimco. As many listeners may not be aware of, you've had members of your team travel down to Pimco's head offices in California on their own dime to really research Pimco, to get to know Pimco, to understand Pimco, and do due diligence on behalf of your clients. So thank you for that, and thank you for having me today.
Great. Perfect. Thanks, Alex. So let's get started with the basics here and give our listeners a brief description of what a bond is.
Yeah, that's a great way to start, and actually maybe even before we do that, just to familiarize some of your listeners with Pimco. They might not be familiar with who we are. Sorry, so maybe we could start with just 30 seconds there. So Pimco is the world's largest active fixed income investor. We manage over $2 trillion on behalf of millions of investors around the world, including here in Canada and the US and Europe and in Asia. And we've been doing that for 50 years. We are truly a global organization with our head office being in Newport Beach, California, but we do kind of search the whole $120 trillion fixed income opportunity set around the world to find opportunities on behalf of our clients. And so that first question is an important one. What is a bond? Let's start with the basics. Everyone, I think, knows a little bit about the stock market, but not too much about bonds and what they're all about. So think of a bond basically as an instrument between a borrower and an investor or a lender. And the best way, I think, to understand that is through an example. So let's say you are a company and you want to expand your business. Maybe you want to invest in a new plant, or you need a new building, you want to hire some new people, and you need money to do that. And let's say it's $10 million. You could issue a bond for that $10 million. And then an investor, such as a Pimco, could purchase that bond for $10 million. In exchange for the $10 million, Pimco, or the investor, would receive a coupon payment or an interest payment on some regular interval, say annually. And it might be, say, for example, 5%. And that's what we get for giving that $10 million. And then at the end of some fixed period of time, usually on average of about 5 years, we get that $10 million back. So as an investor, as a bond investor, you get income, a regular income payment. You get stability, because bonds generally don't fluctuate in value to the extent that equities do. So you get diversification from your equity portfolio, and you generally get some safety too, because bonds, generally speaking, are more safer or senior to stocks. And what I mean by that is, let's say something bad were to happen with this company that you'd bought the bond for. As an equity investor, if the company were to go bankrupt, you'd potentially have all of your holdings wiped out. As a bond investor, if you were more senior in the capital structure, you might have some assets pledged against that bond as collateral. So even if the company went bankrupt, you might be able to recover some and potentially all of your money. So that's a little bit about what a bond is all about.
Great. Okay, that's fantastic. So let's discuss how the bond market works and trades, and the magnitude of its size and why this is important.
Yeah, let's do that, because again, I think people know the stock market is big and they can buy and sell a share of Apple on their phone in 30 seconds. But I don't think they think too much about the bond market. And the bond market is actually bigger than the stock market. So it's very large. It's about $120 trillion in size. And in Canada here, it's only a little over 2 trillion. Globally, it's about 120 trillion. And unlike the stock market, it doesn't trade on these liquid exchanges that you can access on your phone. Bonds are accessed through intermediaries or dealers around the world, like banks, but they're much more difficult to access today than they used to be. And this is in large part due to the 2008 financial crisis, where the whole financial system was at risk of failure. And there's been a lot of regulations put in place since that time, and particularly around banks and what they can and cannot do. And so banks that used to hold hundreds of billions of dollars of bonds in their inventory for their clients like Forge Advisory to access, they, for in large part, don't do that much anymore. So it's become more difficult to access these individual bonds, and large bond investors like the Pimcos of the world, can still do that on behalf of their clients. And I think that's one of the reasons uh, organizations like Forge Advisory have partnered with the Pimcos of the world to access those bonds on behalf of their clients.
Yeah, absolutely. So, on another point, you read a lot about interest rates in the media these days. So, can you dive into a little bit on, how interest rates affect bond prices and investors?
Yeah, we certainly are seeing a lot about that in the media, and a lot of investors might not really understand what does that mean to them. So let's first off just touch on interest rates as a policy tool for central banks. And what I mean by that is central banks around the world, so they have them here in Canada and the US and in Europe, they have a goal of essentially having prices go up at around 2% a year, so inflation targeting at around 2% a year, and to have economies grow kind of steadily in kind of that Goldilocks fashion, not too hot, not too cold, but have a good amount of growth. And that's kind of their mandate or their policy, if you will. And how they do that is they use some tools. And one of the main tools is setting interest rates. And the best way to understand this, I think, is through an example. So let's talk about a recent one and that's fresh in all of our memories, and that's March of 2020 when coronavirus hit all of us around the world, and economies around the world essentially ground to a halt very quickly. So no more growth, no more hiring, no more spending. Economies essentially ground to a halt. And so central banks leaped into action and they essentially lowered interest rates right down to close to zero. And they did that to help try and stimulate some growth in the economy. So if you're a business, maybe you could borrow money cheaply to help pay your employees, to maybe try and build your business. If you're a homeowner, maybe you could borrow to buy a home, et cetera, et cetera. So interest rates went right down to basically zero to help kind of restart and re-kick the economy, like has happened over the last kind of 12 to 18 months. Conversely, if the economies grow too fast, then the central banks could actually rise or raise interest rates a little bit to help slow down that growth. So that's how interest rates are kind of used. And they affect investors because when interest rates are low, obviously it makes it more challenging for investors and savers to make money. If you were traditionally an investor who might buy a GIC, well, today GIC rates are typically below 1%. If you bought government bonds, well, today they're somewhere around 1.5, 1.6%, and cash essentially is paying close to zero. So that makes it more challenging for investors to save and earn that income that they look for with bond investments today.
Right. So keeping on the theme of, interest rates, even though they're historically low, they've started to go up recently. So can you touch on why that is and what it means for investors?
Yeah. Yeah, that's a great point. They have started to go up. And so that 1.5, 1.6% you can get on a government bond today, that might have been, 1.2 or 1.3 even a month or two ago. So they have started to go up. And the question is why? And the answer to that question is really that markets are forward looking. And so all the participants in the market, they think about what the future might hold and they try and kind of price that into investments today. And that's kind of what's happening in the bond market. So we talked about inflation and we talked about how when there's growth and prices start going up, central banks might start to increase their interest rates. And what's happened recently, as I'm sure everyone who's listening to this would be only too well aware, is when you go to the grocery store, your food costs are probably higher than they were a year or so ago. When you go to the gas pumps, they absolutely are higher than where they were a year ago. I have a personal example that I think is kind of instructive. I was recently on vacation down in the East Coast, and we rented a car. And the car we got was a minivan that had about 75,000 kilometers on it. It had been repainted. I think it actually might have been a taxi at one point. And I think what had happened is the rental car companies, they just can't get cars. There's a shortage of cars around the world. There's a shortage of the parts and the components that go into cars, particularly computer chips. And so they're going out and they're buying used cars and they're buying up a lot of the inventory of used cars. And if you look at the numbers over the last year, I think used car prices are up 50% year over year. And that's simply because of a lot of the structural problems that are happening in the economy. You've got coronavirus shutting down plants that make these computer chips. You've got weather events. You've got a lot of issues that have really slowed the availability of some of these parts. And so you've seen prices go up in a lot of things. And that's what's happening in the market today. And you're seeing interest rates start to go up because of that inflation that the market is starting to see. And in terms of what that means for an investor, well, when interest rates go up, the price of an existing bond goes down. You may have heard about that, reading that in the newspaper, and you might wonder why. And the best way to understand that is also through an example. So let's say you owned a bond and it pays some interest rate, say 5%. And let's say the next day, a new bond was issued that pays 6%, and it's the same kind of bond. Well, of course, you're going to prefer the bond that pays the higher interest rate, the one that pays 6%. So you would want to go and sell the 5% one to buy the 6% one. And in doing so, that would push the price down of the 5% one. So the impact that's having on bond investors today is particularly bond investors that have more sensitivity to movements in interest rates. The price of their bonds are at least temporarily going down. So that's a little bit about what's happening today.
Yeah, got it. Some great examples there, and certainly some that we can all relate to. So, given how well stock markets have done over the last few years, some investors might ask if you should even own bonds at all. And, why do you think an investor should consider holding bonds, especially given the not so flattering media coverage of bonds in the past few months here?
Yeah, that's a great question. I talked about bonds are yielding low amounts and the price is going down with interest rates going up, and you might be thinking, well, geez, stock markets go up every year, and why should I bother even owning bonds in the first place? So let's talk about that. And so I talked at the outset of three reasons you want to own bonds, right? You want to own them for income. There might be investors that require income, and you can, even though government bonds are paying you maybe 1.5% or so, you can own bonds that pay you more. There's bonds out there that pay you 2, 3, 4, 5, 6, 7, or more percent. So income is still something that many investors need. Stability is, I think, something that a lot of investors need, and diversification. So those three things are still relevant, and it's easy to kind of lose that when stock markets seemingly go up almost on a daily basis. But it's important to remember that stock markets don't always go up. Lots of examples throughout history. Probably the most famous example that maybe some of the investors listening to this call didn't even experience personally, but in 2008, stock markets went down roughly 50%. If you had an all-stock portfolio and you lost 50% in 2008, just to get back to where you started, you need to grow by 100% just to get back to even. That's a pretty big drop. If you owned bonds in 2008, depending on the kind of bonds, some were positive that year, and some that were negative were marginally negative compared to the rate of stocks. So the diversification certainly paid off. In recent years, 2018, the Canadian market was down 8 or 9%. There were some bonds that were positive that year. Even in March of 2020, or even in September of 2021, the U.S. stock market was down almost 5% in 1 month in September just recently, and there were bonds that were not down nearly as much or potentially even positive as well. So that diversification certainly has paid off historically, and it is expected to continue to pay off on an ongoing basis.
Sure. So, many of our clients do hold Pimco investments in their portfolios. So could you explain the role Pimco investments play in a portfolio? And, while you answer that, touch on a few things Pimco does differently compared to other bond investments, for example, exchange traded funds or ETFs.
Right. Yeah. I mean, obviously we do what the things that we just talked about. We're going to provide that income and the stability and the diversification. But I think there's a lot of value in active management. So Pimco is an active investor. So we're looking around the world for opportunities in the $120 trillion opportunity set. A lot of passive investors, ETFs that people have heard of. So ETF stands for Exchange Traded Fund. They're typically low cost, more passive solution that just kind of blindly follow an index or a benchmark. We do things very differently. We don't blindly follow an index or a benchmark. And I think there's a lot of value in doing so. And we've kind of proven so over time. But just to give you an example of some of the things we might be able to do a little bit differently, we talked about interest rates going up. If you buy passive investments, typically in Canada, they come with a lot of vulnerability or susceptibility to these rising interest rates. And many passive indices in Canada are down, 3 or 4% this year as a result. As an active investor, you can be a little more nimble and avoid owning some of these bonds that have a little more interest rate sensitivity, and kind of steering clear of that risk, or at least minimizing the impact of these rising interest rates. And so there's some active investors, including Pimco, that have generated positive returns this year because of the more active nature of trying to avoid some of those interest rate sensitivities. There's other things active managers like Pimco can do. There's the global opportunity set, where there might be a bond in other parts of the world that an individual investor wouldn't be able to access. There's newly issued bonds. People don't really think about this, but in the bond market, roughly 20% of the entire market is kind of rolled over each year, because bonds aren't like stocks perpetual. When a stock gets issued, it lasts forever, or at least until that company lasts. When a bond gets issued, it can last for different amounts of time, but on average, it's about 5 years. And that means roughly 20% of that whole $120 trillion market is kind of rolled over every year. And Pimco, with our size and scale, we can access some of those newly issued bonds on behalf of our clients. And there's often good value to be had in some of those new issuances. And there's a lot of other interesting things that you can do as an active investor. When companies are stressed, which many of them have been during the COVID period, they need money, and they often look to bond investors to lend them that money. And large investors like Pimco can deal with some of these industries. You think of industries that were particularly impacted by COVID. Think of airlines and hospitality or cruise lines. They often have a lot of assets that they can pledge against these bonds. So if you're a cruise line, you can pledge all your cruise ships. If you're an airline, you can pledge your planes or your equipment or your routes or your gates or your frequent flyer programs. And that gives large bond investors comfort that they have some safety with this collateral, and they can go out and lend to these companies and get competitive interest rates for those bond investments. So there's lots of interesting things active investors can do to add value and generate good, solid, kind of risk-adjusted returns for their investors.
Got it. Okay. So now for a question that I think is on everybody's mind is, what is Pimco's outlook or opinion on, both the stock and bond market for the rest of the year, the near term coming up here?
Yeah, that's, I guess, the $64,000 question, isn't it? And I wish I had the easy answer for you. Obviously, the COVID crystal ball is a little foggy these days. There are some uncertainties in the world. COVID is, obviously one of the biggest ones. It's going to be tough for the economy to grow and for companies to be successful against a backdrop of investors not being able to, or people not being able to travel and spend money in the face of COVID. So that's going to be a bit of a question mark. There's also a bit of uncertainty around inflation. So those two things do create some uncertainty. I'll tell you kind of what our base case is, a term that we use at Pimco. And with respect to inflation, our base case there is that a lot of the inflation you are seeing today is what we call transient or more temporary. There certainly are risks to the upside of inflation, like we talked about, if they can't get some of these supply chain bottlenecks fixed, and there continues to be plant closures and energy problems around the world, that could continue to cause inflationary problems. But it is our base case that at some point in kind of the first half of 2022, inflation does peak. Because remember, inflation is just the change in prices over time, usually measured on kind of a trailing 1 year or 12-month basis. And the example I used earlier about cars, right? Used car prices are up 50% year over year. So when we go out a year from now, the point of comparison is a car that was 50% more expensive than the previous year. So it's not likely that the price of used cars continues to kind of go up at that level. So if that settles down, you're going to start to see some of this inflation noise settle down too. So that is our base case, that inflation kind of gets under control at some point in the next half of the year. And it's obviously becoming a bit of a mug's game to predict COVID, but assuming COVID does settle down and the vaccination rates continue to pick up, that's going to be a very positive thing for equity markets. And overall, I'd say, we're cautiously optimistic there. There are a lot of good companies in the world and, potential for growth as we come up off of the bottom of this COVID impacted market. So we're cautiously optimistic for, various equity markets around the world as well as we head into 2022.
Great. Yeah, that was a fantastic overview and primer on bonds, fixed income, inflation, interest rates, and really a whole, whole list of topics that are on the minds of our clients and listeners for sure. Any other insights you'd like to pass on at the current time?
Yeah, that's a good question. I guess I'd say so. I've been working with investors for the last 25 years or so, and one thing I've observed over that time, there's always lots of noise, and there's always lots of emotion in the marketplace. And investing and people's money is an emotional topic. People work hard for it. It's important to them. They take it very seriously, and it can become an emotional thing. And one thing I've just observed, especially in recent years, and we've all seen this, that the world is becoming more emotional and more polarized. And I think part of that is driven by the media and social media. And, none of these things make money by, giving us bland headlines. Their job in the media is to provoke an emotional reaction to all of us. They need to try and get our attention, right? There's so many things after our attention these days. So they don't get our attention from a headline that reads, the market moved 0.3% today. That's not very attention getting. But if they have a headline that says the market plummeted 100 points, well, that's a much more attention getting emotional headline. And guess what? Those are exactly the same things, but one sounds more emotional than the other. So I would just, if there's one thing I would say, I'd say just, try and stay calm and not let yourself be impacted by some of these short-term emotional attention getting headlines. And these algorithms are all out to drive our emotions and provoke emotional reactions from us. So stay calm, maintain that diversified approach to try and help smooth out your investment returns, which will then in turn minimize the chance of making these kind of emotional mistakes that investors can sometimes make with their portfolio. I know that's not huge advice, but I think it's one that's worth all of us reminding ourselves to listen to as we move forward here.
Right. No, certainly those are some wise words. So Alex, thank you so much for your insights today and being here with us. As always, we do encourage our listeners and clients to call us with any questions, and we'd love to hear from you all. Thank you so much.
Yeah, thank you, Mihail. I appreciate it.